Hello traders. For today's analysis I decided to cover gold market, and I will speak about potential direction on this market, and also about the current pattern that I see that is developing here. So I will start with the futures market first. This is the gold on the futures market, and you'll find out that there is actually massive control zone around 1777. So this 1778-77 is a great control zone that we got in the previous consolidation, as you see on the left side. So on the left side we got like consolidation here around 1777 and 1778. Now the price got some climatic action at the beginning of the week. Basically we got a climatic action and the selling climax. Then we got a retest phase and the buyers came. Pretty much natural reaction based on this climax. But the point with this one is we reached the resistance area right now. So because this control zone, once we got a breakout of that control zone, now it can act like resistance and is acting like resistance. So this is pretty much big control zone. And watching the 30-minute time frame, I found that basically thing that we are having like we got like a rising wedge formation. So we're starting to contract here, as you see. So we start like a wide, and then we start to contract right there. We start the contraction. I think this is basically the very late stage of the buying of this from this rally. So I do expect actually, and my recommendation will be to watch for a downside movement, downside breakout, to confirm this rising wedge, and then eventually watch for some kind of the pullback or the rally for something like this. And then for the downside, speaking of the intraday levels, this level actually quite interesting, around 1766. And then of course the major lows that we got here, right there, around 1753 and 1750. So for now, I will say the market started to do like a wedging form, and this rising wedge is taking basically in the last literally 15 hours. We created this kind of pattern. I think this pattern is pretty much in creation. So the option will be to watch for eventual breakout. For the downside breakout, we got this good control zone in the play, like a resistance zone, and to watch just a confirmation that sellers basically started there and they spotted this opportunity. Because you can, I will be very too early to do anything from this stage when we are still contracting. So this can still keep going on, and you don't want to lose that efficiency. So you want to be there when the market is moving, right? Not when the market is contracting or just doing nothing or just sidewaysing or just fighting, right? So my recommendation will be, based on this scenario, will be to watch for a downside breakout of this lower trend line, which is basically the lower trend line for this rising wedge, and then watch for just a rally back after the breakout. The rally will be on the light volume, and so this can be a good sign for the further downside movement. Again, downside objective 1765 and 1750 level, 1752. Great zone in the play. In case of some bigger upside movement, then the price will just kick in, and with the more buying power, there is a tons of the swing highs and clusters that we made from the previous price action, right? Tons of the clusters. So I guess there will be lots of resistances above this as well, in case of something like this. The price will hit first and make some kind of a climax on the upside, and then eventually go down. That's also an option, but still you need that downside movement to start to confirm this. So that will be my advice. Watch for the bear opportunities because of it's a late stage of the buying. Buyers are losing power. They start to contract and stuff like this, and we're still in the downside trend, and we got tons of the ledges, and we have a ledge and resistances. So I guess the bearish opportunities are pretty much a good choice here, but only if there is a confirmation and a breakout, and we start that breakout, which can be actually pretty soon. That'll be all for today, guys. See you all tomorrow morning.